All right, welcome to Falcon Forward. My name's Peter. I'm here with Mike Tangy, our president, and we're recording this on August 26th, so it's Wednesday. I think it's Wednesday. I'm trying to keep my days straight. Getting a lot of catch-up work this week, which is good. So, Mike, how's things out in your neck of the woods?
All's going great, Peter. September 1st, we have a handful of larger accounts that come up for renewal. So been going through those meetings. You always get nervous on stuff until things get done. And it's nice to finally have the meetings, see the client's appreciation for the work that we've been able to do for them, and get them wrapped up and look at October and November.
There we go. Yeah, we've definitely got a lot going on. I was talking to Bill yesterday. He's working on a lot of things. I mean, we're going to cross the finish line in some big internal projects that we're trying to get over the line and just get a little bit, I don't know, easier on the remote work stuff, which is great. So, anyways, today's topic. So we're talking about basically like work comp and PEOs, or maybe not even PEOs. So there's a lot of different things going on, kind of on this worksheet that we put together. So I'm gonna turn it over to you. I'm gonna let you kind of outline the problem that you're trying to solve this week, and maybe a couple highlights and things that we can take away from your experience there.
Excellent. What we're going to talk about is a fictitious client that we have that recently came to us, and their situation was they went to their they went to their payroll provider for their workers' comp coverage, and that's something that's probably been going on for at least the last 15 years or so. And if you think about it, what is a payroll company? Every 2 weeks, you got to report to them of what your actual payrolls were, who's getting what. So it's broken down by employee. That's something that people have always done to make sure the right person gets paid every 2 weeks when that shows up. And then what does a payroll provider do is they deposit that money in their employee's checking account. They debit the employee. They'll handle the taxes. They'll handle the withholdings. They'll handle things like your 401k, child support, if you're unlucky to get stuck with that. And just kind of work through all those things. So, and again, maybe it's been going on longer than that, but to my knowledge, about 15 years or so ago, the payroll provider said, what other revenue streams can we tap into? And one of those was workers' comp. And they solved an issue that insurance companies had ignored up to that point, which was, workers' comp, you give a forecast at the beginning of the year, and then at the end of the year, the insurance company says, all right, give me all your payroll reports from these past 12 months so we can see if your forecast was accurate. And it's time consuming. And it's just one of those not fun projects for our insureds. And so payroll companies said, hey, we can actually do something here where every time you report your payroll, we'll automatically calculate your workers' comp. We'll eliminate the bulk of that year-end audit. You still have it because you still got to check things like right class codes and use of subcontractors and some other stuff that can come up in an audit. But it greatly reduces that, hey, give me 12 months worth of data because you've been collecting that every 2 weeks throughout the year. And so companies were like, wow, I don't have to do my audit anymore. Sign me up. So payroll companies started to make a pretty good dent in workers' comp, and specifically insurance agencies books of work comp business, at least for the lower risk class codes. So insurance companies evolved then and said, all right, we hear you agents. You've been asking for this forever, but we'll give you now the ability for your clients to do this ongoing payroll reporting. So that's now an option for almost all clients on it. And so kind of alleviated that need. But what workers' comp carriers can do as well is, they have licensed agents at their payroll providers, but they're not providing necessarily the level of expertise or service of reviewing certificates. Do you comply with these types of things? Generating certificates. So they're viewing all that as a kind of a cost center, in not necessarily giving the same level of customer service that good agencies will provide to their clients when it comes to reviewing certificates, helping them through messy claims. The broker plays a lot of roles in a workers' comp, and a big part of that is if a claim is in large claims where there's a serious injury, it's not just hey, this is, give this person a check. This is one of their employees that they take a lot of responsibility for, that's going through a very difficult situation where they're physically injured. And of course, employers are concerned by this and they want to make sure they're well taken care of. And they want to, and if the insurance company isn't doing a good job, again, we'll get involved with that and bring them up to, make sure that if it's the wrong adjuster handling it or someone needs to get replaced or someone needs, the fire lit under them, that's all things that we'll do. And if you're an employer and you're working with your payroll provider, you're literally calling your payroll rep who doesn't understand work comp, doesn't understand the system,
Mm.
and will be like, hey, this is a problem. And the rep's like, I don't know what to say to you. It's just not there. You're calling a call center trying to get things figured out. Well, at the same time, your employee's calling you up being like, man, I'm getting bills at my house. I'm getting, this is not good. So it can get very, very messy on it. And it's one of those great examples of on paper, it looks great. Like, hey, we do all these things. We provide payroll services to you. You report your payroll every other week. Just check this box and you get work comp as well. Like, again, on paper, that looks great. I get to save money. That looks great. I don't have to do an audit. That looks great. But if you think through the reality of what is workers' comp and why do you carry it, it can quickly unravel. And unfortunately for this prospect, hypothetical client that we're talking about, that's what happened to them.
Huh. So like, what I'm hearing a similarity here is with PEOs, and I kind of, but they're not like, these are like, it seems like they're offering less than a PEO would. Is that sort of the idea from what you're saying here? It's a quite a bit different.
Yeah, correct. So a PEO or professional employment organization, they'll provide a gap where workers' comp either isn't available, traditional workers' comp, and that could be due to the high hazard level of the business. It could be the specific claim levels of that company. It could be multi-state operations. So PEOs, what they do is they wrap the workers' comp in with the benefits. So you got to be a certain size company to justify the costs of providing like a 401k plan or providing health insurance. And then remember that each state regulates insurance. And so now in our remote society where people can work wherever they want, you could have, one employee in 5 different states. In the past, that just wasn't something that was really contemplated when businesses set up so a PO will say, hey, you can offer all these things that you couldn't do on your own, or it would be so cost prohibitive, or there just isn't a carrier that would provide it. And PEOs can fill that gap on it. So, and PEOs will provide workers' comp support because, again, a lot of times they're working with these heavy hazard businesses that, maybe had too many claims, and workers' comp carriers are looking at them just saying like, wow, like we can't write you because you have too many claims. You can get in with a PEO that will take a more aggressive claims focus, and then also pool you with larger groups that now you can finally get insurance back again. So PEOs are a little bit different than what we're talking about here, which is a payroll company. And it gets confusing because some payroll companies provide PEO level services, but the recognizable payroll companies like a Paychex or ADP, what we're talking about, or the situation that my client was in, was they were buying their workers' comp from their payroll provider, and weren't giving the level of service they need. Plus, there are a lot of issues in how things were set up that will run through the mistakes that were made.
I was going to ask, like, my next question is, how hard is it to break away from a payroll provider and kind of, I guess, hit the reset button on, okay, we need to go a different direction? But it sounds like you might be building up to that.
Yep. And again, that's so to break away from a PEO provider is difficult because you don't have claims history, because it's a part of this bigger group. So it's difficult to get claims history, and a lot of work comp carriers won't necessarily trust the claims history because it's you're basically saying, hey, here's the claims history for this massive group of thousands of companies, and
Right.
here's the claims for this particular company. So there's been some level of mistrust between the insurance companies when you're trying to leave a PEO. Separately, if you're trying to leave your your payroll provider, it's actually very easy because all the payroll provider is doing is providing a single work comp policy to this business. So it looks just like us in that it's a single policy. It's got you get loss runs, you get all those types of things. So very easy to break off the workers' comp from a payroll provider. You're correct. It's much more difficult to break from a PEO.
Okay.
Yep.
Gotcha.
Okay, so let's go back to my situation. So I had a prospect that we're working with, and they have 10 years ago, they set up an entity and they opened up a senior living franchise. So went great for them. So they expanded. And about 5 years in, they decided, hey, we're going to open up a separate location. Our demand's great. We're going to open up a separate location. So as very common for our insureds who will operate multiple locations, they set up a new entity for this new location. And so it was at this time that they went to their payroll provider and said, hey, we'd like to, the payroll provider said, hey, we can offer you work comp, we can offer you work comp, we can offer you work comp. Payroll provider knew what their payroll had been. They knew what their employees' job classifications were doing, and they offered a very low cost quote to them. So they said, all right, great. Again, 5 years in business, they hadn't had very many claims or serious claims, so didn't necessarily see the risk in working with a payroll provider, and they just saw low prices on it and signed them up on it. In this situation, though, so you have entity 1, 5 years old. It's experience rated. It had hit the threshold of years in business and premium to be experience rated. They set up entity number 2. The way how experience rating works is if there's common majority ownership across multiple entities, then they're both eligible to be experience rated. And so the first mistake this payroll provider did was they said, oh, this is a new entity. Then we're not going to, you're not eligible to be experience rated. And it's actually, technically, it was to our insured's detriment, but it's actually the law. You have to do this. You have to, when you have these, you have to submit to the bureau. And because sometimes people will do it to try and get away from a bad experience mod. So you have a bad experience mod over here, and people are like, oh, we'll just set up a new entity and employ everyone under this new entity on it. And so the law is when you set up new entities, you have to do this commonality of ownership and make sure. In this case, it wasn't done, and it was actually to the insured's detriment because remember, you have entity 1 over here that is experience rated. It's got good experience that should have flown through and applied to entity number 2. The second issue that they did was they set them up on a separate policy. And that isn't necessarily, it's something that they could do on it, where some people would insist that, hey, we want to keep things 100% separate for accounting purposes. But in the case, we would never recommend that to a client, or at least we would advise them, hey, if you're going to do that, there's fixed fees that every insurance policy will have on it as it relates to, and especially on a workers' comp policy, there's expense constants, there's other state fees that get applied to it, policy service fees and so forth, that if you have 2 policies, you're paying 2 sets of fees. And again, these weren't super large policies, so the fees as a percentage of the overall premium were 2, 3, 4% on it. So just by having them on a single policy, you're effectively eliminating, in this case, almost 5% of the fees on it. So again, not explained to the insured. They just said, oh, you 2 separate things, set 2 separate policies. And the insured went along with that. The other piece, kind of these hits keep piling up for them, was the insurance company said, oh, this is a new business, because the insurance company is just going by what the agent is telling them, which in this case is the payroll provider. So payroll provider says, hey, new business. Insurance company says, okay, great. We put a debit on our new clients because they're brand new in business, and we want to see a few years of experience before we give them our most preferred rates. So the insurance company, it's not really their fault because they're going by what the agent is instructing them, which is, hey, this is a new entity. If the insurance company would have known that these 2 were related entities run by the same folks, they wouldn't have had that debit applied. So you're getting this kind of multitude of hits, and any one of them in their own, it's almost more of like a nuisance. If you call $500, $1,000 a nuisance, but when you start adding them up, now it's all of a sudden becoming a very big nuisance on stuff. And then their whole point of, hey, we're going to go with our work comp payroll provider because they're dangling these low rates, is coming back around in hurting them. But the
Sure.
biggest issue, so I'll pause there. Any questions on any of those three missteps that were done?
Just quick. So it sounds like these payroll providers are still going to standard workers' comp markets. Like this isn't their own paper that they're offering. They're going to normal markets like a broker would. They just don't. They're missing a couple things here. Okay.
Yeah, and they're going to a lot of times to the same carriers that we represent. So if you're an agent out there, you can take over these policies and provide your level of expertise, fix these issues, and then again, if a claim scenario comes, be able to guide them on this. So yeah, no, it's these workers, these payroll providers are effectively agents that are in competition with us, representing the same companies that we do. Absolutely.
Sure. I
Yep.
wasn't sure if they need special paper. That's all. That was kind of my one thing. So that's good to know.
Yep. Yep. No, it again looks no different, and that's again why it makes it very easy to leave these payroll providers. In that it's same carriers out there. They're just
Gotcha.
doing things a little bit different on how they set stuff up. So the other issue now these companies 8 years or so in business, and unfortunately they have started having a couple of claims. So the bigger you are, the better it is when it comes to claims, because if you think about it like a ocean scenario, like if you throw, a large rock into the ocean, it's going to do nothing. If you have a very small puddle, throw a large rock into it, all the water is going to go splashing out and make a big mess and all those kind of things, and the water's going to go away. That same theory applies for the bigger you are from a workers' comp premium. If you throw the equivalent of a rock, which is a claim, into that, how does that affect what's in there? So if you're larger premium, you're going to be able to absorb those claims with less impact on your experience rating. And so now this particular client effectively had two ponds over here rather than one combined into one lake to absorb any claims that had come in. So unfortunately, they have started having a couple claims. So now that they're seeing their experience ratings spike up unnaturally, or they will in the future, because this hasn't been pooled together. So kind of these, and that part is actually going to rear its head in the future for them if they didn't make these changes, and then something that they'd be stuck with for 3 years as the experience rating cycles through for each of these things. So again, further issues that are almost looming on this. But the biggest piece that to kind of highlight, or the biggest issue for them is I guess fortunately for them, it hasn't been a terrible situation, but they had an employee with a relatively serious claim, where there's medical bills and there's these kind of things showing up. And again, for this particular client, it worked okay, but they saw what the potential could have been on it. So if you have an employee who's seriously injured, so forget about the premiums and the bills and all that kind of stuff. A good employer is gonna be like, wow, like I don't feel good about this. Like this is a bad thing. Like someone who was helping me out, helping me run my company, injured themselves while working. As an employer, regardless of if the guy was doing something dumb or however it happened, you're going to feel very bad about that, and you're going to feel responsible that, hey, I want to make sure, it's not quite like your child, but it's that same mentality of someone that I'm responsible for is injured, and I want to make sure this person gets better as fast as they can and gets back to where they were before. I want this to be an easy experience for them. And so if you have a bad claims adjuster going on, we will get involved. We as your agent will get involved, and we'll make sure that person's doing their job right, or we'll get that adjuster replaced if they're not doing and ultimately can't come around on it. And the whole kind of squeaky wheel gets the grease, and there's a reason why we stay involved with tricky claims, because we want to make sure it gets done. We're not just going to sit back and be like, oh, okay, well, man, sorry you had that work comp claim. Hope it goes well. Thanks for your premium payments all those years. A big portion of our job as brokers is getting involved in making sure claims are resolved promptly and the employee's taken well care of. So imagine that scenario where it's not going well and you're getting your work comp through your payroll provider. You're calling an 800 number and trying to explain your situation of something you're not familiar with to begin with. Work comp or all insurance is kind of confusing, probably on purpose. it's a whole other topic. But you don't have anyone to call that will know it's you, and then more importantly, know how to get things fixed on it. So, and then now you got an employee who's thinking, man, my employer doesn't care much about me. I'm getting these medical bills. I'm getting these phone calls from debt collectors. I don't know why stuff is going to me. Or I can't get an appointment with this doctor that they kept. The doctor's canceled 3 times on me and I can't get in, and my knees killing me. I'm in pain. Like that's all really bad situation and not reflective of a good employer. And again, we've seen these types of claims, unfortunately, and we'll get very involved until these things are fixed and righted. And again, that's an exception. But if you're in a higher hazard business, like in this particular company was, like you should not be with your work comp. You should not have your work comp with your payroll provider, because it again, if things start to unravel, there's no one that's going to really be your advocate that understands insurance on it. And so this particular hypothetical company that we're talking about was in a similar situation. It wasn't to that bad level, but they saw, man, like if this did continue going south, like it took way too much of my time. This is what the employer was thinking to fix it. I had no one to call. I need to get out of this as quickly as I can. And that was the conversation that we had. Thankfully, we'll be able to right those wrongs. None of those are fatal errors or things that can't get fixed. And going forward, they're going to be in a much better spot where they can continue doing what they're doing, which is growing their company, taking care of their employees, and making sure that, if something bad happens, that they put in place the proper things to take care of these folks and get them back on their feet as quickly as possible. So,
Well, that's good. A good ending to a complicated set of issues. So it's encouraging. And something that I didn't really know existed. Maybe because oil and gas, we don't really see that happen too often, but maybe it is because of the size of the companies or something, industry or anything like that. But just another facet of insurance that I could probably dig into for another couple hours.
yeah, again, one of those things that for us, it's extremely gratifying to be able to, because they came to us being like, hey, we need help. And they didn't know the level of help, like the things we talked about with the billing or with the experience rating and the combining and the fees. Like that part they were unaware of. They didn't know. They just knew that when they had a claim, it didn't go well. And so again, gratifying when they come to us as people that can help. And again, hopefully that they don't have cause for us getting super involved. And again, it's pretty rare that you do get involved to that level. But again, why do you buy the insurance? Is that so if a bad thing happens, that you're able, the successful business that this husband and wife have devoted their life to, and massive financial risk on it, and it built up something nice that is rewarding them, that isn't taken away from them. And that's effectively what insurance is.
Totally. Another really cool way to look at it. So, well, Mike, I think we'll cap it off here as we
Awesome.
approach the 5-minute mark. But just a great, quick episode. Hopefully, I don't know. I because I'm part of the recording, I don't typically go back and re-listen to it. But I did catch my wife listening to one, so I concerned for her because, I don't know how interesting she finds it, but nonetheless, she likes to listen to it, so it's cool. Anyways, we've got some great things coming up the rest of this week. We have a rugby event on Saturday. We've got some new hires that we're training, all kinds of fun things going on. So thank you guys for taking time out of your day to hang out and listen. And if you have any questions or comments or topics, or you'd like to come on and talk with me and Mike, we'd love to have you. So until next week, Mike, we'll hang it up here.
Thanks, Peter.
All right.